Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. Welcome back to our first podcast of 2025. Happy New Year to everyone, and we're so glad you could join us again. Ernest, how was your vacation?
It's a long story. We missed our flight, which caused us to miss our cruise.
Oh, no.
But then it worked out in the end.
Yeah, you got on the cruise?
We did. In
Okay.
the next port. It was very stressful and cost us a lot of money, but we made it.
How did you miss your flight? It was just a scheduling thing at the airport?
Yeah, I don't really want to get into it, but that's what happened.
All good, all good. My vacation was good. We went to Grand Cayman. Have you been there?
No.
Yeah, it's
They
very
have
nice.
rays there, right?
So-
Like manta rays?
They have stingrays. Good one, yeah. So we did play with the stingrays. They have a lot of banks there. It's offshore tax haven, as you know. Very expensive, very nice weather. They have a number of couche-tards and Tim Hortons there, Burger Kings. So we saw some Canadian content. Could almost write this trip off as a business expense, right?
Well, every time I go to the Caribbean, I always see Scotiabanks and like CIBC there.
Well, Scotiabank, CIBC, and Royal Bank have big presence in the Cayman Islands as well. So, Canadians is very close. Highly recommend you go there.
Can you actually withdraw money in those, like the Scotiabanks there?
Well, the Cayman dollar is its own money, right? So when you go to a lot of Caribbean islands, they want the U.S. dollar, right?
Right.
In Cayman, their dollar is actually worth $1.25 US. And then, of course, with the Canadian dollar going down, it's almost $1.50 US Canadian dollar. So it ends up being almost 2 to 1. So buying a coffee at $4 Caymans ends up being $8 Canadian, which is not a lot of fun. But it's on vacation, so you try not to think about how much money you're spending and get back to, we had a good year in the market, so I could spend a little bit of money. So today's podcast, Ernest, we're going to talk about some of the books we read on vacation. We're going to talk about compounding, which is our favorite topic. Should we stick with compounders? What does it mean to be a compounder? And then we're going to talk about Constellation Software. There's some interesting notes. Constellation met with institutional investors over the December, and we had a chance to look at some of those notes, and we'll talk about our insights from those. So I think it'll be an excellent show. As always, if you please subscribe to our podcast. If you like what we say, please follow us on YouTube, Spotify, and Apple. It really helps. We really appreciate all our listeners and followers. And Ernest, I think we'll keep doing the mailbag going forward. We had a lot of fun taking viewer emails and Twitter questions, and we'd like to continue to do that as well.
I think we got an email saying they didn't know what a mailbag is. Do you want to explain what that is?
What a mailbag is?
Yeah.
Well, a mailbag is ask questions, right? To me and Ernest about stocks, the market, whatever questions you have. What Ernest is wearing, for example, and we'll answer them. We love to engage with our audience. So a mailbag is just send us your questions. We can talk about any topic you're interested in.
Sounds good.
Yeah, you were on TV today on BNN Bloomberg. You kind of almost got bumped because there was bigger news than you being on BNN, which was...
So I did get bumped.
Okay.
My original time was 10:45 to be on BNN to talk about some of the stocks that I like.
Yes.
But it turned out that the Prime Minister of Canada decided to make an announcement at 10:45 in the morning as well.
A pretty big one, too.
Yes. So about an hour before I was scheduled to go on, the producer sent me an email and he said, "Hey, can you go on at 10:25 instead?" I said, "Okay, fine, whatever. Doesn't matter to me."
Yeah.
So
we try to be at the studio 15, 20 minutes early anyways,
Yes.
right? To get makeup done. Maybe there's some notes that they want us to go over or talk to the producer, what have you.
Yeah. And so that's what we did. And my theme on it was a very short segment, just 5 minutes long, but my theme on the segment was why Canadian compounders are a good investment to make, especially going into 2025. And the big idea is that I think you always want to own compounders because by definition, a compounder is a company that compounds its value over time. But these types of companies, especially in Canada today, I think are especially attractive, both relative to valuations in the US and what the prices that you're paying for high quality businesses in the US, but also because they are in Canadian dollars, which is at a much lower price than the US dollar.
So everybody intuitively understands compounding, right? You put $100 in the bank, let's say you earn 3% interest. At the end of the year, you have $103. You reinvest that $103 at 3%, and it keeps growing and growing and growing. And the higher the rate of return, the longer the time horizon, that $100 can grow to a magnificent amount of money, right? And all you had to do was just come up with the money and put it into the bank, right? That's the magic of compounding. The beauty of compounding with investments, with buying shares of companies, is hopefully they can earn more than 3% on your money by reinvesting in their businesses, by buying back stock, by making M&A, by adding new business lines, growing their businesses. And then all of a sudden that $100 turns into $200 in 5 years, 7 years, $400, what have you, right? And so you always want to invest in companies that can reinvest cash flows at high rates of return. That's what compounding means.
Yeah, and when we talk about compounders, I think this term is often kind of loosely thrown around to include any company that share price goes up.
Sure. Or pretty much any investment will compound if you're earning a return and not losing money. But it doesn't mean we're defining a company that has specific characteristics as a compounder. And why don't you go into detail about that?
And so these are companies that have a very specific objective of taking the money that they're making and then using it to make acquisitions or other investments at higher rates of return than they would by, buying back their own stock or by paying it out as a dividend. And so the classic example of this is Constellation Software in Canada. They pay a very small dividend. They generate a lot of free cash flow. And what they do is that they'll go and make acquisitions of software companies, then make money, and then next year they'll make even more acquisitions of software companies and compound the cash flows this way. And you can just look at the stock price to know how well this has worked.
I can't recall what the market value of Constellation was when it went public in 2006, but today it's about $90 billion, right?
Right.
So how did it achieve a market value of $90 billion? It did it by using the cash flow that it earned from the businesses that it bought to reinvest, to buy more businesses and more businesses and more. Had Constellation Software said, you know what, our business model isn't to buy businesses, it's to buy a few businesses, but to pay out all the money that we earn in dividends, it wouldn't be worth $90 billion.
Right.
And arguably, apples to apples, if you've gotten all those dividends, you would be way worse off for that kind of business model, right? The business model where you can continue to make M&A to the end of time if you know how to do it, because there's thousands and thousands of companies that they could acquire.
And I think it's useful to make a distinction between companies like Constellation, where they're making acquisitions and with a very specific target return.
Yeah.
Where, like, for example, Constellation aims for 30% on most of its deals. Mm-hmm. Versus something like, I'm just making this up. If like Oracle decided to buy some strategic company to plug into their portfolio, it may make sense for their customers and what they're trying to achieve as a business, but there is not a specific objective where they're trying to meet a hurdle rate on all the acquisitions that they're doing and compounding the cash flows in a continual basis. And I think that's the distinction that you have to make between a compounder and like kind of a normal company making acquisitions.
So what successful ingredients go into making a compounder? Clearly, management, but is there a specific business model, a type of product or service? Does it matter? Like, how would you define the characteristics that you're looking for when you start searching for a compounder as an initial investor, you're starting out?
Well, I think because I think that the math of compounding and the idea that you can grow a company very quickly by making acquisitions is quite well appreciated by a lot of people, and a lot of people try to start compounders by making a lot of acquisitions. But I think what differentiates the ones that are successful and the ones kind of the wannabes is, number one is real compounders are very disciplined in the price that they pay. They'll make acquisitions, and there will be a very specific return hurdle rate. So 30%, let's say, for Constellation, like Couche-Tard or CCL Industries and some of these other companies, they target 15%.
And that's because that specific business model doesn't lend itself maybe to 30% returns.
Yeah.
Software business generally has fewer capital expenditures and spits out a lot of cash flow. So that business should have higher returns on invested cash flow versus a building and buying gas stations. It's just the business model. That doesn't mean you still can't make a ton of money on either business. And in fact, Couche-Tard, which is a not as good business model, has been a terrific performer over the long term. It may be even better than as good as Constellation Software.
Yeah, some other elements that I think you want to see, in addition to a strict discipline on price, is a management that has very deep knowledge of that specific industry. So they really understand how to operate businesses. And because they are sector experts, they're able to run the acquisitions and generate synergies, whether it be costs or operational improvements that other acquirers can't do.
So Alain Bouchard at TFI International understands trucking, logistics. You plug and play him into a Couche-Tard, he may not work out. So
exactly.
Alain Bedard, sorry, not Alain Bouchard. Yeah. That was a bad example using the two Alains, but yes.
Yeah, so in that example, he is an expert in the trucking industry, can run a trucker better than anybody else.
Yeah.
And so if he makes acquisitions, he can generate extra returns from them.
That's right.
And that's another thing that we like to see. Another common aspect that seems to be present in compounders is a flat, decentralized organizational structure where a lot of the operations and the responsibilities are handed down to the lower levels.
So a perfect example of that would be Warren Buffett's Berkshire Hathaway.
Yes.
Right? Berkshire Hathaway is one of the biggest companies in the world. And at head office at Berkshire Hathaway, there's Warren Buffett and maybe 20 other people.
Right.
At the most. Right? So Warren's making some big grandiose decisions, but at the end of the day, the decision of running that business one or business two comes down to those people who are the CEOs of those direct businesses, right?
Yeah.
If they want to make a large acquisition or they want Warren Buffett's input, they'll reach out to him, but Warren's not sits on the phone with each company all day long talking to them about what they're doing.
Right. Sorry. Yeah. And ideally in these situations, the CEO or the team at the top, what they're responsible for is not really the day-to-day operations of all the businesses that are in the portfolio, but more about like establishing a culture and establishing the incentives that can govern how these businesses are being run. And that's really what enables the business to go out and make acquisitions, because it doesn't take up more of the CEO's time to be able to have to integrate and add it to the portfolio. It's just saying, okay, this is how we're going to do things, and you go out and figure it out.
The culture, the incentives, these are, and the type of business organization, these are the things that truly matter, of course, long term. You laid it out perfectly. Having the expertise, the knowledge about the industry is so important. You can't just plug and play and drop a person in. Sometimes it works. Sometimes people do have the playbooks, but maybe if you leave them at the top and still run it decentralized, it could work. And it really is about making acquisitions, right? Not paying those dividends, having that excess free cash flow to put it to work, and really being patient. Not all business models are going to do, just because it's a compounder doesn't mean you ignore cyclicality. TFI, trucking business, tough year in 2024. That could rebound in 2025, and and things could work out tremendously for it. Some businesses are more or less cyclical. Obviously, Couche-Tard, not a great year for that type of business, given high inflation, weaker low-income consumer. But when things turn, the nothing has changed with the process. As long as that business doesn't get disrupted, right? Anything can happen with any business.
And so what's interesting is that once you found a quote unquote compounder, if you have a business that is able to reinvest its cash flows at 15, 20, 25, 30% per year, assuming that they're able to do that, of course, like the stock becomes cheap very, very quickly.
Absolutely.
Because you can do the math, right? Like even if you paid, and I'm just making this up, but let's say you paid 100 times earnings for Constellation Software, but they're able to redeploy, they're able to grow 30% per year and reinvest at 30% per year. The multiple is going to contract extremely quickly. And I think that's what the market has historically missed about a lot of these companies is their ability to compound into their valuation very quickly.
Absolutely. So when you look at 1 year and you say the PE of Costco or Ferrari or Chipotle, wow, those are very high prices, 45, 50 times current earnings, 40, 50 times 1 year forward earnings. I'm not going to buy that. I'm going to wait for that multiple. I know we all know they're great businesses, but you're paying a too high price. That may be true in the short term because something bad will happen to every business, or you'll have some kind of unknown event, world event that hurts commerce. Anything can happen. But over the long term, the compounding gets rid of all those problems. And how many times have we said, I'm not going to buy that, it's too expensive, and either A, the multiple goes up, the multiple may come down, but the growth rate is faster, or 10 years later, it doesn't matter. I think about whether I would have fiddled around paying 75 times earnings for Amazon or 65 times earnings for Amazon 7, 8 years ago, it wouldn't have mattered, right? It definitely would have mattered in the short term for performance, but we're not in it for the short-term performance game. We're in it for the long-term compounding. And so the business model, the compounding of that investment is going to outweigh any mistakes you make on pricing. If you got the business wrong, nothing's going to help you.
And I think just to further hammer that point home is that I think it's very common today, especially given some of the valuation metrics that like high quality businesses like Costco are trading at like maybe 40, 50 times earnings, that a lot of people are saying this is a repeat of the Nifty 50 experience.
Fair enough.
For those that don't know, the Nifty 50 is a group of high quality companies in, I think it was the 70s.
Yep.
That they were dubbed the Nifty 50 because they were sexy growth names that traded at high valuation multiples.
Names like Polaroid,
McDonald's,
Xerox, I think the original IBM, or called something. These companies, Procter and Gamble, these companies had 80 times earnings, 90 times earnings, some of them 60 times. Polaroid was the Apple of its time. Do you remember the Polaroid story?
Well, I've read about it. I wasn't born yet.
Yeah, you weren't. Okay, fair enough. I mean, we all had Polaroid cameras as kids. It was lots of fun. When you think about it now, they're ridiculous. But comparing Polaroid to Apple is insane. But that was the Apple of its time, just the stock that you must own. And so, talk about what you like to reread things about the Nifty 50, especially in this time.
Yep. So the Nifty 50 is often invoked as an example of speculative excess, where people get carried away by the growth narrative of the stories. Like some of these companies, they pay too high a price and then it collapses because a lot of these stocks fell like 60, 70, 80% from their peaks. in the next decade to come.
Yeah.
But I read a paper, interesting study from the Wharton professor Jeremy Siegel, who who went back and studied some of these companies in the Nifty 50, and he wanted to see whether the Nifty 50 was actually a bubble. And what he found was that if you owned the basket of Nifty 50 stocks at the top,
You were the dumbest person to pay the highest price ever. Yeah.
and you held them through the next 3 decades, you actually earned the same return as the S&P 500.
Yeah.
Now, some of them went to zero, but then some of them ended up doing spectacularly well. And so, based on this observation, Siegel concluded that the prices that investors were paying for these companies at the top were rational. Like, these were growth companies that had exciting futures ahead of them that investors were rationally paying high multiples for. And so then the question becomes, well, then if they were rational prices, why did they lose so much money in the next decade? And his explanation is because rather than these companies being very overvalued and then being fairly, then like collapsing, the market just for whatever reason became overly pessimistic about the prospects of these companies.
Well, there was a good reason from the 70s and 80s. We had
yes.
The highest inflation in many, many years. Interest rates went up, making stock valuations less attractive. And that's kind of what happened in the 2021 era, where we kind of had a little bit of the repeat again of the Nifty 50. Valuations of quality stocks of the biggest names went up huge. Interest rates went up, inflation went up, stock prices collapsed in 2022. And for whatever reason, we're back here again. But we can get into why companies are being valued for what they are and the largest names. But anything to finish off there about
the main conclusion there is that growth and high quality companies should trade at a premium. You should pay up for them because these are better companies.
Of course.
And so whether or not they're like overvalued in the near term, I guess that's neither here nor there. But to say that like a company that's growing, like Constellation Software, should trade at like 15 times earnings just makes no sense.
No, it makes no sense. And we all know that in the 90s and the early 2000s, the largest companies in the world are not comparable to the largest companies today in terms of profit margins, in terms of return on invested capital, in terms of business model, in terms of platform growth in so many huge areas: cloud computing, software, iPhones, and then of course the potential tailwinds of AI and robotics and God only knows, right? Versus those companies 20, 30 years ago, the large ones were Ford and GM and oil companies and banks, which are much more cyclical. You still could do very well on them, but we believe the names of today deserve to trade at a higher multiple. But Ernest, when you look at we're heading into 2025 here, you look at the trillion-dollar valuations of companies. The top 10 has trillion-dollar valuations. It is a little bit mind-boggling, and I can understand why people are rightly so cautious about how much more growth is in those names. We'll have to see how that plays out, but the demand for the products and services of the very large companies right now certainly justify some pretty lofty valuations, and some of them that we own are quite, in our opinion, inexpensive, whether it's a Google or a Meta.
Well, I don't think big tech stocks are overvalued. Like expensive.
Tesla, maybe.
Well, sure. Yeah. Like I mean, there are certain names that trade at very high multiples, and where I think investors like Tesla, where investors are, I would say, siding on the enthusiastic side about.
For sure.
But I think if you look at the main players like Microsoft, Apple, Google, Meta, even Nvidia, maybe they, like, given the amount of free cash flow that they have and the growth that these companies have, like, I don't think they seem outrageous relative to the rest of the market.
I agree with you. That's why we own a lot of them. So you were going back to our beginning conversation.
Yes.
You were bumped or moved a little bit because Prime Minister Trudeau has resigned as of today. He's going to stay on as Prime Minister of Canada until a new leader is found. And the Parliament is going to be essentially stopped for the next few, no big decisions. Of course, many Canadians are concerned about this capital gains tax change in Canada. We have to act and assume like it's going to become law, even though it's not passed into law yet. So, those clients that have any questions about that, please reach out to us, of course. But Ernest, any change in our philosophy or strategy as a result of Canada not being in a mess at the moment?
No, I wouldn't say so. The whole point of owning compounders is that these are companies that can grow regardless of the political environment.
Yeah.
If things are good, then they'll do well, and if things are not as good, they are, number one, these are generally the best at what they do. Mm-hmm. So they're able to make acquisitions of weaker competitors in bad times. Yeah. And I think that for the ones that we've talked about on this podcast many times, they have a track record of doing so, and we think we'll continue to do so.
And with the weaker Canadian dollar as a result of interest rates coming down faster in Canada, as well as political uncertainty, as well as the U.S. economy doing better, that actually helps a lot of our Canadian favorite compounders, right? Because most of them, even though they are listed in Toronto Stock Exchange, or maybe they even dual listed, the bulk of them earn revenues outside Canada, get paid in US dollars. If they want to make an acquisition in Canada, well, yay for them. A lot of them now get US dollars. They could translate it in the Canadian cheaper. So there's actual benefit. There's a benefit for the Canadian dollar going down for some of those stocks.
I do think that, fairly or not, Trudeau has been viewed as a negative overall for like the policies that has been in place from him have been viewed as a negative for the competitiveness of Canadian investment overall, especially in the out west in the energy sector. And I think that even within his party, there's a recognition that he probably overstepped too far in certain directions, and that's probably a positive for Canada going forward.
Yeah, and we have no idea which political party will win the election when election comes. But I would say that you and I and the team at Baskin Wealth are long-term bullish on Canada.
Yeah.
We have tremendous amount of resources here. We have great universities. We have so many advantages. We have the parliamentary system is tremendous. The social security system in Canada is tremendous. And we have strong immigration here. And with the Canadian dollar lower, maybe we're going to get a lot of foreign money and interest in our assets to help us grow. And, you talk about AI, we have a lot of cold weather here. That's great. We have a lot of natural gas to power those AI data centers. We have a lot of natural gas that we can export to the rest of the world. So we're pretty excited about some of the investments that we've made in those areas. And we see long-term great benefits. And, even though we're a little bit bearish on the Canadian dollar now, it could easily go back up to 75 cents, 80 cents with improvement in the Canadian economy, and anything can happen. Lowering rates is a good thing. It will help ultimately, in our opinion, the long-term growth for Canada and our stocks. So let's talk about our feature discussion, Constellation Software. We've owned Constellation Software now, Ernest, I think almost 10 years.
Something like that.
Something like that, yeah. Wish we researched it earlier, but we've had a long-term investment in Constellation Software. Another very strong year for the company, although fewer larger deals. But what we really want to talk today about is some of the updates that from the company. The company met with institutional investors in December and provided what we think were some really key insights as to what they're thinking about their business as they head into 2025.
There were a few things that were interesting from that report. So the first thing was that I think the CFO indicated that they were thinking about lowering the hurdle rate for small deals.
Yeah.
And I think this was this was very surprising to me because so to take a step back, Constellation, like their general model is that they have teams of like business development people. They go out and they establish relationships with these small software companies, and then they'll make a business case for it, and then like they'll acquire them, and that's how that's their bread and butter.
Yeah, if you have a small software company, let's say you're selling, I don't know, some kind of billing software to pickleball courts.
Pickleball management software.
Yeah, pickleball management software. And so Constellation Software will eventually figure out and find out who you are and maybe send you an email and try and get a phone call, a lunch meeting, a coffee, what have you, and then follow up once a month to see, how your business is going. Can we be of any help? If you're ever interested in selling, let us know. We'd love to work with you. And what sets us apart than instead of you selling to private equity is we'll keep we'll keep most of your team, and we won't put leverage on your balance sheet. And if you want us to keep working here, you can. And, we'll give you a wad of cash instead of, private equity usually likes to give you a little bit of cash and then maybe shares in a new company with a lot of debts that may or may not work out. So more certainty. Plus we have the knowledge and the data that can help you grow. And we never, I think they like the Warren Buffett thing. They don't like to sell their companies.
Yep, they're permanent owners.
So it's really appealing, right? As an owner of Baskin Wealth, one day I'm going to retire. I would like the legacy, just like David would, of our company to live on and do what we do and have our employees have jobs and get paid more. And, so it's enticing to sell to a business that will treat you as a permanent owner.
So that's Constellation's bread and butter. And then over the last couple of years, they have, I think because they're having troubles of making enough of these small acquisitions, they've also been making larger acquisitions. And that's actually a different process overall, because these are generally large deals that are maybe marketed by investment bankers. They have a competitive bidding process, and the operations are a little bit more complex.
So the deals are not scaling as fast because there's more copycat businesses to Constellation Software, similar businesses that are doing the same thing as Constellation, as well as private equity has now gotten into this space. We see announcements, Brookfield's in trying to buy software companies. Power Corp just gave money to a company that's trying to acquire. There's a lot of money out there to acquire software companies. So Constellation is not a single bidder anymore. It's competitive.
And some of this is just due to the size. Yeah. Like Constellation's a much bigger company than it was even 5 years ago.
That's right.
So just to be able to keep up the pace and continue the compounding, they have to do things a little bit differently.
They're a $90 billion company now. So making an acquisition of a $5 million revenue software company, it's great. And it could be additive long term, but it does nothing to the $90 billion company market value, right? You have to make thousands of those to make an impact.
Right. And so historically, Constellation has targeted, they have two hurdle rates. So the rate of return that they're trying to earn on acquisitions. They have a high 20s return for smaller acquisitions, and they have a lower return that they've never actually publicly said, but for large acquisitions. And it seemed in this meeting that they were, and the reason why Constellation did this is because they recognized that once you lower the hurdle rate, it acts like a magnet, and everybody then pursues deals to that new hurdle rate.
Yes.
And they didn't want their team to lose the discipline of being careful in their underwriting for new deals. And that's why they held the hurdle rate for small deals high. But it seems like from this management meeting that they were thinking about lowering that threshold, which is really interesting because they've never said this before.
Yeah.
And would be a change in philosophy overall. And I think part of this has to do to the second point about employee retention, which is that in a world when you're competing against all these different people who are trying to buy these software businesses, like maintaining you could say I want to earn 30% on all my deals, but that doesn't mean that the seller's going to sell it to you. And so I think it's becoming a little more frustrating for their employees. Number one, to be able to complete deals, but also to maintain the pace of acquisitions to continue compounding.
Yeah.
And I think that's one of the reasons why they are contemplating this change.
Yeah. And so this is, it's not a huge course of action, but it is interesting, and it will have ramifications, of course, for its spin-offs as well, right?
Yep.
Because if Topicus wants to make an acquisition, or Lumen, or the next spin-off that happens, they all have to conform to that new hurdle rate, whatever it is.
Well, I'm not exactly sure if that's true.
Okay.
I think one of the reasons why they did these spin-offs is because it allows them a separate platform to experiment with different things.
Fair enough.
Like,
fair enough.
but yes, like
Yeah.
it is a major change to the business and the overall operating philosophy if they lowered the hurdle
If
rate.
they do. And let's keep in mind that this is not an announcement that the company is doing this. They haven't publicly said it, that they're going ahead and lowering they're just thinking about it.
Right.
And so that's a change in the thought process. And, companies have an open mind. There's a lot of things, I think Constellation Software, and we heard Mark Leonard say that he would have done differently. Having the knowledge today versus setting up the company, today versus setting it up almost 20 years ago, that he would have done differently. And so they're always learning, and no question, the most important point is it's become a much larger company, and to maintain the valuation, to reward employees, with the stock price, it needs to find ways to grow just as fast. The good news is that the company seems extremely confident in its targets going forward. It still feels like it can complete multiple large deals. It says that the pipeline of large deals is very active. And one of the things that I found interesting, Ernest, was the company still has room to reach more targets as it adds more employees, as it's almost not even aware of 70% of all software deals that happen out there, right? And so it needs to get more front and center with software companies, networking, making relationships. Constellation kind of doesn't really work with investment banks, right?
Not for small deals. No.
No.
These are largely too small to fall under that scope.
Yeah, so the larger deals will be acquisitions of companies maybe that are having trouble, that have balance sheet issues, and looking to spin off a portion of their business, or a company that maybe the market thinks is too complicated and it wants to slim down, focus on its core competency, and Constellation will come in there. And these are new things that it's doing. Right? It didn't make large acquisitions like this a few years ago, plus spin-offs. So there's lots of ample opportunities for Constellation to grow going forward. Anything else that you read in the notes that interest you?
Well, there was some. I think AI is a bit of a hot topic of the day.
Oh, for sure.
In wondering whether Constellation's business is any at risk from AI, and I think that I think the management basically said there's no risk. Because number one is because the software that is typical in Constellation Software companies is very mission critical. Like, it's necessary to operate the business. Like, everybody's trained on it. So, to use an example, one of the businesses that they have is like library management software, right? And so, yeah, like, it's hypothetically plausible that you can use AI to write another version of a library management software that is a little bit cheaper.
Yeah.
But then you'd have to retrain all the librarians on it, who are generally probably not the most tech savvy people in the world. Like, you have to maybe re-index every book in the system.
Yeah.
And like, to what end?
Yeah.
Like, you might save like a few $1,000, right? So like in essence, there's not really very much risk to the business, and they'll manage as necessary.
Yeah, and it could open up more tailwinds, right? As Gen AI becomes more as it proliferates, people may write new softwares for new products and services, and create whole new business lines that Constellation can start acquiring.
Yep.
We're at the opinion right now that AI is not going to replace every single worker and every single software and every single one of us going forward. But
At least not yet.
at least not yet. And so it could be additive and launch to lots of new business lines and opportunities. And so at the moment, I think Constellation's management sees it much more as an opportunity than as a threat. That could change, of course. It was very interesting. It's always interesting to read also about how what Constellation thinks of its competitive advantages as well, right? As it makes an acquisition of a company versus, okay, you can be bought by Joe Blow private equity, or you can be bought by us. If you're bought by us, hey, we've made 1,000+ acquisitions. If you want the biggest payday, the other guy has only made a few. We have so much data, we have so much coaching, we have so much training. We're not just giving you the biggest payday, but we're also going to make your business better going forward. And that's what it can offer, right? Your management team can now network with other companies that we've acquired that and there's learnings that can happen, right? So your pickleball management software and the library management software, maybe there's ideas that they can share that will help both businesses. I'm just throwing it out there. It doesn't have to make sense, but
Yes.
right? And so the more and it's just so fascinating to learn and listen about Constellation Software, the more we find out about the company, the more tidbits we learn, it makes the business case even stronger. But no business is infallible, and Constellation has, for sure, the threats of AI is a risk, copycats is a risk, lowering its hurdle rate may lower the potential returns that people get going forward, but may allow it to scale faster. So, no business grows at 35% a year forever.
No, but I think the thing that people have to understand is that, Constellation might not be able to compound capital at 30% going forward.
Yeah.
But even if it compounds at 20% per year,
Yeah.
and I think it'll probably be higher than that, you're still going to do quite well.
If you're compounding at 20% a year, your share price should double every 4 to 4.5 years.
Right. There's not many companies that are compounding at 20% per year.
No.
So, still very enthusiastic shareholders of the company.
Awesome summary. So what did you read on while you were waiting at the airport for all your trips to happen?
So I read 2 books.
Yeah.
I read The NVIDIA Way. The first one was by Tae Kim.
Tae Kim.
Tae Kim, who's I think he's a Bloomberg journalist.
Okay.
But it's a background of NVIDIA, and obviously the hot topic of the day.
Unbelievable. The stock was the best performing stock on the S&P 500, I think up 130%. Rocking and rolling into 2025, Ernest, with the stunning announcement by Microsoft that it's going to spend $80 billion on data centers in 2025 alone. That's mind-boggling. And then, of course, you add to Amazon and Google and Meta and all the other companies that are going to be spending money on data centers. Is there enough chips in the world from NVIDIA to supply $300 billion of data center spend in 2025?
So the way Kim, the author, portrayed Jensen Huang, the CEO of NVIDIA, is that he is a visionary in the same vein as
Elon Musk?
or Bill Gates or probably Steve Jobs. Right?
Okay.
He is a ruthless competitor that wants to win at all costs. Like there was a funny anecdote where an NVIDIA chip came second in a performance ranking.
Yeah.
And he just laid into his staff about this, right?
They lost out to the competition, AMD or whoever. Yeah.
And it was the chip was fine.
Yeah.
But he wanted to win everything, right? So that's the kind of person that's running the business.
Yeah.
And he's also able to see ahead of the future, years in advance of everybody else.
Yeah.
So
is he an Elon Musk type guy who's working 16 hours a day and playing Diablo 8 hours a day and on Twitter another 4 hours a day? Or
what's interesting? Probably I don't think he's on Twitter 4 hours a day. But what's interesting about NVIDIA is that the whole heritage of the company was because they love video games,
Yeah.
right? That's why they were convinced that
Make a
video games were going to be a big thing,
huge.
which is as surprising as it seems, like was not a consensus opinion when they started NVIDIA. And so they started a company to make
Graphic cards,
graphic
right?
cards. They invented the term GPU. I didn't even know that.
I don't even know what a GPU stands for, but yeah.
But then over time, they pivoted the business to take advantage of what was coming next. And so what's relevant to the AI story today is that in I think it was 2016 or 2018, don't remember the exact date, Google wrote a paper on the transformer, which is the foundation of all the AI stuff that's going on today. And Jensen read this report and he said, AI is going to be huge, right? Like this is going to be a big thing. And remember, this was way before ChatGPT was a thing, right? So he was able to see well in advance that AI was going to be big, and he directed NVIDIA to invest to ensure that its chips were leading at that time, right? So clearly somebody who can see into the future, or at least in this specific instance he did. And hats off to him.
Yeah. And if you read interviews of Jensen recently, he is more bullish than ever on AI. Now, part of that, of course, is being a CEO.
Yes.
You have to be extremely promotional. And when you're running a $3 trillion company, you say some hyperbole for sure. But, he feels that the AI demand is going to be outrageous, and he's also excited on robotics and quantum computing, and he feels he can turn his company into a provider of chips into a multi-AI type company.
Right.
So I'm kind of sad we don't own the stock right now, but who knows what will happen in the future. So you recommend the book? Was it?
It's an interesting read.
Yeah. Was there actual firsthand interviews with Jensen?
I think there were.
Yeah.
I think there were. I think what happened was that he learned that he was was writing a book.
Yeah.
So he reached out and scheduled an interview. And I think the other interesting thing that...
So it's not a hit piece.
No. Yeah, exactly. Because I do know somebody who worked at NVIDIA, and he said that the co-founder had a phone installed in the toilet, so he could answer calls while he was, taking care of business.
Yeah.
And so that's kind of the things that could happen at some of these companies.
It's called that. You can do that on your phone. Okay, so excellent book. Did you read? And you read? So that was your first book.
That was the first book.
Yep.
I've
downloaded it on my Kindle, so I'll read that one next. Yep.
The second one was a little more challenging for me to read because it was written in French, but it was called "Passion for the Job: Leadership Lessons from My Career" by Louis Vachon, who is the former CEO of National Bank.
Yeah, and he was CEO of National Bank for, I think, 17 years.
Something like that.
Yeah, he was one of the longest CEOs of a Canadian bank in our lifetime, and successful career.
Very successful.
National Bank, stock that we own for clients, I own personally, has been the best performing Canadian stock, I think, going back since 2000, so over 20 plus years. And so what insights did Mr. Vachon, and obviously for those that don't know, yes, he is from that Vachon family.
Yep.
The Joe Louis cakes, I remember taking them to school, the moon cakes and the Joe Louis, delicious. I will not eat them now. They're very bad for you, but at the time as a kid, loved them.
So apparently when he was a kid, his father's family idea of a family vacation was to drive around and look at factories. Right. So maybe some people are just built differently.
One of the things, before I cut you off, but also his family has a relationship to TFI trucking as well.
Yep.
So Vachon, TFI, and National Bank, a really great Quebec heritage in business there with that family.
But I think it was with a lot of assistance from Google Translate. So maybe I misread some portions, but...
Don't tell your French teacher, Ernest.
No, I dropped it after grade 9.
Me too.
But I thought the most interesting part was when he was kind of talking about how he sees National Bank compared to the other big Canadian banks.
Yeah.
Because unlike TD and Royal and Bank of Montreal and Scotiabank and those banks, National is focused on Quebec.
Yeah.
It's more of a regional bank. And so I think he talked a lot about understanding what that means in the context of running a bank, and understanding that National doesn't have to be everything. It
doesn't have to replicate Royal Bank, right?
Yeah. It doesn't have to have a big branch, like a retail bank branching footprint across all of Canada, because that's just not the game that they choose to play in.
Yeah.
And similarly, like they were thinking about how do they grow the bank, right? Because, they're kind of stuck in Quebec. And he said, well, we could go to the US, but like there's already like 1,000 banks in the US. So what are we doing differently there?
Yeah.
We can go to Europe, but there's negative interest rates there. We can go to China, but who knows what happens with China. And so kind of maybe bizarrely, he ended up concluding maybe we should invest in Cambodia.
Yeah.
And that's what they did. And it actually ended up being a successful investment.
I had a friend that went to Cambodia over the holidays and had a wonderful time. Said it's becoming extremely modern and a new tourist hotspot. So I think Vachon's legacy at National Bank is that, years ago, you would say that the National Bank deserves that Quebec discount.
Yep.
Smallish bank, mostly focused on Quebec. Why should it trade at it should trade at a discount to other Canadian banks. And now it trades at a premium to other Canadian banks because of the ability to diversify their assets into Cambodia, for example, into the United States for doing some
non-performing
loan investing. But the big idea was really focusing on wealth management.
Yep.
And custodial bank services, which has been a tremendous asset for National Bank. And now, of course, a new challenge for it because it's acquired Canadian Western Bank. And so opening up more exposure to rest of Canada, and just an exciting story for that company. And Vachon did an amazing job. One of the, Canada's Jamie Dimon, so to speak.
Yeah, I really think that's what you want from a company, is understanding what your strength is and understanding where you have a right to win and where you don't have a right to win. And I think the Canadian Western Bank acquisition is a perfect example of that. Like they're not competing in the most competitive markets, which is like they're not trying to sell you mortgages in Toronto and Vancouver.
Yeah.
They're entering into Alberta, into Alberta commercial lending, which is something that they have is complementary to their business, and that there's ability for them to add value.
Lots of different ways with the Canadian Western Bank, and we talked about that acquisition, and hopefully we'll talk about it more as it gets integrated. I think the deal closes in the first quarter of 2025, so National Bank will amalgamate Western Bank's operations into its business later this year, and we'll touch on that going forward. So thank you so much for joining us. We appreciate all our listeners, and we wish you all the best for 2025, and we'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.